But why? What's driving this relentless surge in the stock market? Is it just a bubble waiting to burst? Or is there something more substantial behind this rally? Is it just me? Or does it feel like nothing can bring the stock market down these days? Every time you turn on the news, it seems like the market is hitting new highs. I mean, seriously, we're seeing some pretty wild stuff. Stocks are soaring, and it feels like there's no end in sight. But what's really going on here? Good news, bad news, the market seems to just keep rallying. It's almost as if the market is on autopilot, climbing higher and higher regardless of the news. Jobs report looking a little iffy. Market goes up. It's like the market is wearing rose-colored glasses, seeing only the positives and ignoring the negatives. Inflation still stubbornly high. Market shrugs it off and keeps climbing. It's almost surreal how resilient the market has been in the face of what would normally be considered bad news. It's enough to make your head spin. How can the market keep going up when there are so many potential pitfalls? We're talking about a year-to-date growth of almost 30% in some major indexes. That's insane. Such rapid growth is almost unheard of and certainly not sustainable in the long run. Now, I'm not a financial advisor, just a random dude on YouTube, but even I know that kind of growth isn't exactly normal. It makes you wonder if we're in for a correction soon. And it's got me thinking, what's really fueling this bull market? Is it sustainable? Are we riding a wave of optimism? Or is there something more concrete driving these gains? And most importantly, what should you be doing about it? Should you jump in and ride the wave, or is it time to be cautious and protect your investments? Well, in this video, we're going to dive deep into the 3 key reasons why the stock market seems to be defying gravity right now. We'll look at the underlying factors that are driving this unprecedented growth. We'll break down the good, the bad, and the potentially ugly, so you can make smarter investing decisions. Understanding these factors can help you navigate the market more effectively. And remember, this isn't financial advice, just some good old-fashioned research and analysis. It's crucial to stay informed and make decisions based on solid information. Do your own research, consult with a professional, and let's get into it. Together, we'll explore the current market trends and what they mean for your investments. One of the biggest factors keeping the market afloat right now is the simple fact that there haven't been any major catastrophic events to really shake investor confidence. This is crucial because the market thrives on stability and predictability. When investors feel secure, they are more likely to take risks and invest their money, which in turn fuels economic growth. Yeah, sure, we've got geopolitical tensions, trade wars brewing, and the occasional natural disaster. These events certainly create ripples and can cause short-term volatility, but they haven't been severe enough to cause a long-term downturn. The world's a messy place, and there's always something going on. From political upheavals to environmental crises, the news cycle is never short of dramatic stories. However, the resilience of the market is often underestimated. But here's the thing, none of it has been bad enough to completely derail the economy. Investors have learned to navigate through these turbulent waters, adapting their strategies to mitigate risks. We're still seeing relatively strong GDP growth, which is a key indicator of economic health. A growing GDP means that the economy is expanding, businesses are doing well, and there are more opportunities for employment and investment. The job market is holding up okay, with unemployment rates remaining relatively low. This is important because when people have jobs, they have money to spend, which drives consumer demand and supports businesses. And while inflation is a concern, it hasn't reached those scary, economy-crushing levels yet. Inflation erodes purchasing power, but so far, it has been manageable. Central banks are keeping a close eye on it and are ready to take action if necessary. Now I know what you're thinking. Graham, are you serious? The news is full of doom and gloom. People are struggling. It's true that the media often focuses on negative stories because they grab attention. And you're right, things aren't perfect. There are sectors and communities that are facing significant challenges. In fact, for a lot of people, things are really tough right now. The disparity between different economic groups is widening, and many are finding it hard to make ends meet. We're seeing this weird disconnect where the economy looks good on paper, but it doesn't feel that way for a lot of folks. This disconnect can be attributed to various factors, including wage stagnation and rising living costs. Wages just aren't keeping up with the rising cost of living, making it difficult for many to maintain their standard of living. This is a critical issue that needs to be addressed to ensure long-term economic stability. And that creates this underlying anxiety, even when the headlines are talking about economic growth. People are worried about their future, and this anxiety can have a dampening effect on consumer confidence and spending. It's a complex situation that requires careful management and policy intervention to ensure that the benefits of economic growth are felt by everyone. Here's the thing about the economy. It runs on spending. It's a cycle that fuels itself. When consumers open their wallets, businesses thrive, and in turn, they hire more employees, who then have more money to spend. It's a continuous loop that keeps the economic engine running smoothly. When people buy stuff, businesses make money, they hire more people, and the whole cycle keeps going. This cycle is crucial because it creates jobs, boosts production, and fosters innovation. Every purchase, no matter how small, contributes to this larger economic mechanism. And right now, despite the economic anxieties, consumers are still spending like it's going out of style. This might seem surprising given the uncertainties, but it highlights a fascinating aspect of human behavior, the desire to maintain a sense of normalcy and enjoyment, even in challenging times. We're seeing record levels of credit card debt, people are buying cars, houses, luxury goods, you name it. This surge in spending is not just about fulfilling basic needs, it's also about aspirations and lifestyle choices. People are investing in their dreams, whether it's a new home, a luxury car, or the latest tech gadget. Part of this is pent-up demand from the pandemic, but there's also this YOLO mentality going around. After being cooped up for so long, there's a collective urge to make up for lost time. Celebrations, travel, dining out, all these activities are back with a vengeance, driven by a newfound appreciation for experiences. Like, the world's a mess, might as well enjoy it while I can. This sentiment is pervasive and it's influencing spending patterns significantly. People are prioritizing enjoyment and experiences, often opting for immediate gratification over long-term savings. Now, this spending spree is great for businesses and the stock market in the short term. Companies are reporting higher revenues and stock prices are soaring. Investors are happy, and the market seems to be on an upward trajectory. But this raises an important question about sustainability. As long as people keep swiping their cards and racking up debt, the economy keeps humming along. Credit has become a significant driver of consumer spending. It's easy to buy now and pay later, but this convenience comes with its own set of risks. But there's a catch, and it's a big one. The reliance on credit means that many are living beyond their means. When the bills come due, the financial strain can be overwhelming. This is where the cracks in the system start to show. What happens when the music stops? When the easy credit dries up, and people can no longer afford to keep spending at the same rate? The impact on businesses and the broader economy could be severe. When interest rates rise and those credit card bills become impossible to ignore, higher interest rates mean higher monthly payments, which can quickly become unmanageable for many households. This could lead to a significant reduction in disposable income. When people have to choose between putting food on the table and making their car payments, these tough choices can lead to a decrease in consumer spending, which in turn affects businesses and the overall economy. The ripple effects can be far-reaching. That's when things could get dicey. The economic stability we've come to rely on could be at risk. If consumer confidence wanes, the entire spending cycle could come to a grinding halt, leading to a potential economic downturn. If consumer spending dries up, the economy could slam on the brakes. Businesses would struggle to stay afloat, leading to layoffs and further reducing spending power. It's a vicious cycle that could be hard to break, and when the economy slows down, the stock market usually follows. Investors start to panic, and stock prices can plummet. The wealth effect, where people feel richer when their investments are doing well, reverses, leading to even less spending. So, yeah, the spending spree is keeping the market party going for now, but it's important to remember that it can't last forever. Eventually the bills will come due and the economy will have to reckon with the consequences of this spending frenzy. It's a delicate balance and only time will tell how it all plays out. Chapter 3, The Trump Effect. Okay, before you grab your pitchforks, let me be clear. This isn't about politics. This is about how Wall Street views the current administration and its potential impact on the market. And right now, Wall Street is feeling pretty optimistic. Trump's promises of deregulation, tax cuts, and a pro-business environment have been like music to the ears of investors. They see it as a green light to go out there and make money, and that's exactly what they've been doing. Now, whether you agree with his policies or not, there's no denying that Trump has been good for the stock market. But here's the thing. Could this be creating a bubble? A situation where the market is so inflated by optimism that it's due for a major correction? Nobody knows for sure, but it's definitely something to keep in mind. When emotions drive the market, things can get irrational very quickly. And when the bubble bursts, it's usually those who got caught up in the hype who get burned the worst. Look, I get it. The stock market can feel like a roller coaster ride, especially lately. But here's the thing, trying to predict short-term market movements is like trying to time the lottery. You might get lucky once or twice, but in the long run it's a losing game. The key to building real wealth in the stock market is to tune out the noise, ignore the hype, and focus on the long game. That means investing consistently in low-cost, diversified index funds like the S&P 500. It means not panicking when the market dips and not getting greedy when it soars. And most importantly, it means staying informed. That's why I created Market Briefs, my weekly newsletter where I break down the most important market trends and investing strategies in plain English. No jargon, no hype, just actionable insights to help you make smarter financial decisions. Remember, markets go up and down, but the smartest investors know how to build wealth long-term. Stay informed, stay disciplined, and you'll be well on your way to financial freedom.